this week we've seen that something called a green shoe has never been more important than it was this week.
Yeah.
Excuse me. Now, this week we saw that the results of the KMRC bond, the Kenya Mortgage and Refinance Corporation, the results came out this week. It was issued by the Capital Markets Authority, CMA, and we saw that, how the bond was structured is that KMRC, the total bond that they'll be issuing is 10.5 billion, but then they'll be doing it in phases. So the first phase was 1.4 billion, and we had a chat about this, I think, in episode 21, if I'm not wrong. And so the 1.4 billion is what was floated, and the results came out. It was actually oversubscribed close to 6 times. So 8.1 billion is what was offered, against the 1.4 that KMRC was taking, and the interest was around 12.5%, which is really, really good, in this market, and even coming from international investors, it's quite tasty. Now, KMRC didn't have green shoe. So green shoe is the facility that you can take more than what you had earlier floated, out of what was given. And there were a lot of views. I saw Esther commenting about this on LinkedIn. Esther, now that they got 8.1 billion in offers, and they were looking for 1.4 billion, and remember the total that they will be getting is 10.5 billion. So 8.8 billion and 10 billion, not that quite a distance. Do you guys think that perhaps they should have just floated the whole 10.5 at a go? Because looking at bonds that have been issued before and the size, for example, EABL that was in October was 11 billion, but then KMRC is just 1.4. So should they have floated the whole thing?
You mentioned you first. So.
You were making a lot of noise on LinkedIn about it.
Oh, my issue. Okay, before I even go on what happened on LinkedIn, I think it's very important to ask or get to know why they resorted to doing it in tranches, do it in tranches, because it could be a requirement by some AFDB.
Absolutely. Because actually the reason why they were going to issuing the bond was a requirement by the development partners, that is IFC, IFDB, so that they can be able to mix this financing with the moratorium, the financing that they have that is more cheaper from the development finance.
So the exact answer to that I might not have at the moment,
but it could be.
I actually think it was more so in terms of capacity. They can't float the phase was based on capacity. So you said 1.4?
Yeah, 1.4 billion.
They needed just the 1.4 and see how that is taken up fast. Because you see there's a use for this, and this is also very novel. Here.
Absolutely.
So they have to first find out whether it's actually going to make business sense, even for the development partners. It makes business sense for them to actually have this amount of money. And like Easter just said, just very loosely, if you float the whole amount and the amount is just sitting there, anything could happen. To
exactly.
That money. Yeah.
Exactly.
The utilization of that money it's not going to be made.
And you need to pay coupons, eh?
Yes, and you need to pay coupons on that money, and then money is not being utilized. So it's better to just do it in tranches and figure out how it's going to be taken up, and then just work from there.
This is actually a good sign for them then, that now you can float the others. It will be well accepted. Now we've had a debate here with Easter before, and Easter makes the argument that I don't know who's trying to me. So Easter has always made the argument that, you see the way these bonds are oversubscribed, EABL is oversubscribed, Family Bank, even now KMRC, that if
KMRC is at 400 and over 400.
Yeah, over 400%.
What is that, man?
So Easter says that if, for example, KMRC had offered the bond at the interest rate, the current interest rate is 12.5. So if they had done it at 8 or 9, would they have still gotten the same amount, the amount they wanted, 1.4? So Easter says that they will get the amount, even if they do a couple of basis points behind.
Yeah, because my argument was you having the oversubscription shows you that the demand is more than...
The market is awash with liquidity.
Exactly. So it means that your pricing is off. It's not at equilibrium. It's your pricing is significantly below the equilibrium, what the market is willing to take.
Yeah.
So as Oltetia, who's the KMRC guy.
Yeah, the boss.
Yeah. The 400% does, I don't care for it. It's pretty, it shows me that if I go to the market, I am assured of some money, of getting what I want. But do I need to all I'm asking is for them to look at the room they have to reduce our price.
Yeah.
And I understand that the government, the rates the government is giving for the bonds they issue, sets a precedence or the floor limit for what any other person can issue in the bonds market.
Yeah.
But even the same argument can be used for the government, because then it means that if the government, very often we find that the government bonds are oversubscribed as well.
Yeah, IFCs.
Exactly. So it shows that they can also reduce the price, the rate to at least 9%.
I have a question for that. Just back to you guys.
Yeah.
So the use of the funds was for mortgage, right?
Yeah.
For mortgage. How much are they charging for these funds?
5%.
The mortgages.
5%.
Yeah, so actually what will happen is KMRC, now they're getting at 12.5. They will be lending this money to banks and circles who will in turn lend for purposes of mortgage. They'll be lending to banks and circles at 5%. So I know at first thought it doesn't make economic sense. I mean, why are you doing this, doing that? But then the thinking behind it, and which is something that we explored in, I think, episode 21, was it is actually a requirement for them to do this. So these development partners, they are giving them these facilities at 4%, 4.5%. Now, they have, KMRC is required to show that they are competitive. They have to show proof of concept that for purposes of longevity, you can be able to raise capital on your own. So this is why they are going to the bond market to raise the bond, so that they can be able to mix very little of this 1.4 billion with a huge chunk of what they're getting at 4%. So they blend it together. Then now they can be able to lend at 5%.
What was the tenor?
7 years.
So it makes sense. Based on the yield curve, the 12.5 makes sense.
Yeah.
From the yield curve perspective, since you're talking about bonds in general, it makes sense where the curve is at the moment.
Just break that down for me.
When you look at bonds, bond issuance, any investor who's looking to get into to play and invest in a particular issue, they actually have to look at the yield curve and see where the average rate is on particular tenors. So it goes 1 to 20 years. So for the 1 year, they have a tenor, that's the 364 T-bill, and then you continue on like that. So currently, at the yield curve, it's around that rate.
12.
For 12, for 7 years. So it's not necessarily that they have to, they're the ones who are pricing it. It's where the market is.
Yeah.
So what would be the risk of going lower than the market?
Maybe, I don't know.
Under subscription?
Yeah, the uptake will be lower.
I'd rather do 2 rounds of under subscription, but at the end of the day get to where I was.
But like you said, they can only take the 1.4, right?
Yeah.
They can only take the 1.4.
Yeah, because there wasn't a green shoe.
Yeah.
Yeah, it's still little money.
It's still little money.
Do you guys think that now from this, that KMRC should probably, in the next phase of issuance, should they put a green shoe on it so that if there's a lot of offers, they can be able to take it up? Because, I mean, look at it this way. 8.1 billion in offers, they are only taking 1.4. The other billions that are left, around 6 or something or 7, it's useless for them because you can't access it.
Okay, for me, what I meant about the uptake initially was uptake of the loans. Are the banks willing to take this money and then lend it to what's the mortgage market right now? How is it right now? Because they may take so much money and then they still lend to the banks at 5%, but then these banks will still sit with this money because there's no uptake mortgage on the other side.
Yeah.
The end user.
Or they can take it and put it elsewhere. In IFBs.
Yeah. And they invest it elsewhere because remember, banks have to invest their excess money.
Yeah.
So they'll put it maybe in bonds. And that's what I was saying. It makes sense why they made it a non-green shoe because and the phases whereby you have to think about the end consumer. How is the mortgage market? That's what I meant. How is the mortgage market and how is the end consumer going to take? What's the uptake? Do you guys have mortgages?
I don't have a
You
mortgage.
see?
I don't have a mortgage.
Are you thinking about
No,
get?
I'm not.
Not in the near future.
Now you see. How many people think like that?
Actually, come to think of it, the mortgage market currently, it's actually not that big.
I think they're what?
Is it?
10,000 or 20,000?
Yeah,
20.
20,000.
Yeah.
Yeah, 20,000 mortgages.
because I'm looking at
Ever
this,
since we started.
Now you can imagine.
just 20,000
Yeah.
Over 50 years or what?
in a population of
Yeah,
what?
yeah.
57 minus
So you have to think
students?
about the uptake of the mortgages because you have to change the mindset of the borrower.
Yeah.
So you cannot take 10 billion and sit with that money. And banks are thinking to themselves, okay, what are we going to do with this cash?
Yeah.
Because, I mean, I was listening to the CEO of Optiven, and he was saying that only 15% of Kenyans, Kenyan adult, own homes. Only 15%. So that would also speak to an opportunity, but then it would speak to why are they not taking? Is it that?
And also,
It's not popular.
how are these individuals financing their homes?
Yeah.
Many of them will start small and start building rooms and live in a particular room as they wait for them Django, to come up.
to be completed.
To be completed. That's how many Kenyans think.
Yeah. Yeah.
And that's what we need to establish.
Yeah.
It's not a matter of whether they can be able to take more, which obviously they can be able to take.
Yeah, they
KMRC could have
can.
taken the whole amount, but the end consumer, the borrower,
Yeah.
changing that mindset is difficult, and
Yeah.
they need to understand, okay, this 1.4, will it be utilized and
yeah.
actually get to the end consumer?
Because there's a chance that it might not.
Yeah, it might not.
Also, it could be, I'm just thinking it could be a very expensive venture even for them because KMRC is taking this cash from the market at 12.5.
Yes.
So you don't want to have 12.5. You don't want to have excess money in your coffers. So I say, of course, they came up with the 1.4 because according to the models they prepared, that's what they made.
Yeah.
That's what they needed for the next whatever period.
Yeah.
So that's what they needed to get from the market. So you don't want to get an extra amount of, say, what, 8 billion?
Yeah.
In excess.
8.1?
Yeah.
Then this excess 6 point something is sitting in your coffers earning what? 5%? Whatever banks offer.
Yeah.
Or whatever ROI you're getting from whichever place you've put that money. And you're paying 12.5 on it. You've not employed this capital, but you're paying for it. So it's not generating any cash.
And you can't force banks to
Yeah,
borrow
you
from-
can't.
to take that money, by the way. You can't force
Yeah,
them.
at the end of the
You
day,
can't
it's
take it out.
willing buyer, willing seller.
Yep.
I mean, Steph, you've mentioned something really important about uptake of mortgage. And I mean, I just want to explore a little bit of why is it that the mortgage market in Kenya is really not that vibrant. And top of my mind, I'm looking at the dynamics and I'm thinking, is it because of how the society is structured compared to the West? So if you look at the West, if you're probably living in a state like New York, people in America don't have atishags. So you have like this, you have a home where is your home forever till you die. But then if you look at the dynamics in Kenya, so someone might be like, why should I get a mortgage for a house in Nairobi? For me, I have a home in Shags. I'd probably just save, build a home in Shags and not buy a house here. So I think the societal dynamics are playing there. What do you guys think?
I have a mortgage. Let's start from there. I have a mortgage.
Yeah.
And it's only because I didn't have access to other financing. And I think many Kenyans look at it from a financing point of view. They don't want to be tied to the mortgage, and you'll find many people taking unsecured loans to finance their construction, or they borrow from the SACCO, where you can borrow more money, and they borrow from friends. We don't have this mentality of taking loans here in this country, especially very tailored loans like a mortgage. We don't have that kind of sense. That's my feel.
No, it's
My
true.
feel.
I agree. But why did you take the loan?
Why did I take the loan?
Yeah, the mortgage.
Because of the rate, it was favorable.
If it's the rate, then it makes sense for me.
It made sense. So yeah.
Where I was headed with that is the financial literacy rates in the country.
Yeah.
So how many people would look at the rates? How many people would compare that to the period of repayment against their incomes and all that? We just looked at in the trivia, the savings rate is at 9%.
Yeah.
How 15% of the adult population owning are those that own homes. It shows a lot.
Yeah, it does. And then there's of course this notion of people being obsessed with building a house in Sharks, where you spend a night or two in a whole year, you know, during the festive seasons, where you go there, spend some time. So people would prefer, let me just build a house in Sharks and not necessarily here. But then now the dynamics of building a house in Sharks, now getting financing for it in the mortgage type of way, can you really get it? Or you have to go now for a contemporary loan and now build a house?
And I think, I believe mortgages, for you to access a mortgage
In the house.
I don't think they do. I don't think they would extend a mortgage to you if you don't live in that, if you don't expect to live in that house.
Okay.
Yeah.
I'm learning this for the first time.
I think that's the case.
I've been wrong my whole life.
You have to live in the house. So it's and that's why many people have seen this also in other shows abroad when they're looking at houses. They actually take a mortgage and live there. The requirement is that you need to have lived there for at least a year in the US. Yes. So many people take that mortgage for that 1 year, and if you expect to sell it, you flip it after the 1 year. But then you have to actually live there for that 1 year. And I believe that's the same case here in this country. So if you're doing it as an investment, it doesn't make any sense to you. And if you're going to go to Sharks,
I've been thinking of doing it as an investment at some point.
I think they will look at it from the point of view of an investment. So you have to take an actual loan for that.
Not a mortgage.
A product, one of the loan products, but not a mortgage, because you have to live in that house. I don't know what the requirement is here in this country, but I believe in the US it's 1 year. That's 6 months to 1 year. But you have to live in the house before you actually can sell it to someone else.
But that requirement actually makes sense for me. It does. It does.
It's a mortgage. It's for your home. It's a home. Not to sell. Or to rent out.
As a financier, all I care for is, are you returning? Are you giving me back the money you're supposed to pay?
I think maybe it's a requirement. It's a regulatory requirement to ensure people actually live in their homes.
Yeah. So I mean, we've been seeing a lot of oversubscriptions recently, and now going into the electioneering year and the cycle that we normally see, that people tend to hold on to their investments, not to invest, probably wait after elections. But in my circles, I've not witnessed that actually. People are deploying capital like election is nothing for them, and I'm happy that is happening, because I think I think we talked with Easter about this, that the thought of election and the narrative of people talking about election now, probably spending is gonna go down and everything. So that narrative itself, the talk about that does more harm to the economy than the actual election. I don't know if I'm making sense. But then just coming back to the bonds market, where now people are holding on to their cash and not putting into investments. Do you guys think that moving into an electioneering year and now campaigns, drumbeats going up, do you think it's going to affect subscriptions for IFBs, T-bills, and even corporate paper?
I highly doubt.
I don't think so.
I highly doubt, because what is the threshold of making that investment? It's 100K.
Yeah, 100K. Yeah, actually, just for our viewers to know that the CBK actually reopened the 5-year, 15-year, and the 25-year bonds. So you can check that out. The minimum is 50 Gs for that. To invest, yeah. Not dollars. No.
Yeah. So by the virtue that you need 50,000 or 100,000, there's already you're locking out a very significant bit of the market.
Yeah.
Not everyone can afford that. When they did the
Emakiba, which was like 10 Gs, I think.
No, it was 3,000.
Oh, it was 3,000. Yeah.
3,000, Bob. I remember because I actually
you invested. Oh, the rate was 10%.
yeah.
How was it? I mean, you got your returns well?
Yes, very smoothly. As in,
fantastic.
I've been looking for it.
Yeah.
I've been like,
if it comes back,
using it. Yeah, exactly. So again, about us heading onto election and of whether or not the bonds will be oversubscribed, I don't think it will be affected, because the people you look. Sorry.
Sorry. I mean, the people who would have the convenience to invest 100 Gs, a ticket of 100 Gs or more.
Yeah.
Do you think that for them election is an issue?
No, exactly. That's the point.
So election doesn't matter for them.
Yeah. Plus, most of these people are institutional investors.
Okay.
Yeah.
In fact, I was going to mention that you can't look at it from the point of view of the minimum amount. You have to look at the investor, the type of investor. The largest investors are banks.
Yeah.
Banks, and then you move into you talked about what? Institutional investors.
So-
Those are the circles.
Hedge funds.
Those are the largest, but the largest currently is banks. So you have to look at it from the point of view of the bank balance sheet and the kind of risk profile that they're willing to take. Most banks don't look at tenors over what? 12 years? No, 12 years. I'm talking about bonds. And that's why you'd find that certain bonds are oversubscribed, mostly by institutional investors because or pensions, like over 20 years. Pensions will put their money there because they look at the long term. But when you look at shorter term papers, let's say 15 year and below, banks will play quite heavily on it. But initially, when you talk about the election risk, the election risk came about a couple of years ago. Okay, 2017, not 2020. Where are we? 2022. With COVID, 2 years have just gone. Where are we? About 2019, just before COVID hit, 2019, it was a bit skeptical. Investors were a bit skeptical about the election period, only because there was not enough certainty as to the individuals who will be running. And when you look at it from a continuity kind of aspect, during the time of Uhuru, 2017, 2017 and 2012, 2013. When it was elected 2013, 2017, there was not much of an issue there because there was a certainty that Uhuru was going to take up the 10 years.
Second term.
The second term. So even when you looked at the subscription, it wasn't really affected. But during this particular time, because presidents can't take more than 2 terms, there was an uncertain period in about 2019 before COVID hit. And you'd find that even the government themselves started issuing bonds that were very attractive. Around even 5 years, 7 years, you saw a lot of papers coming in during that particular time.
So banks are going to take that up.
Yeah, they'll take it up like this. And those are the largest investors actually. Why? Because they know that they need this money for all this construction that's happening. You can't float a bond that's going to be over 20 years during that particular time. The subscription wouldn't be as favorable. Even if you float it, it wouldn't be as favorable because you know where the players are and what they're thinking about. So that's about 2019. COVID hit, those uncertainties, so people moved towards the shorter end. So you found a bit of subscription there in T-bills around 1 year because the rate was much more favorable than the 91 and the 182, especially because of inflation. Your returns were much lower with the 91 and 182. 364 was the most subscribed, and then now everyone shifted to the longer end.
So the 21
the longer
IFBs,
end,
19 IFBs came.
Yes, there was a lot of play even in the secondary market on the IFB space because everyone was looking for safety and return, whatever it was. This is
how active, by the way, is the secondary market?
It depends on the papers, but it is active.
And the size of the ticket.
And the size of the ticket. So the papers, ticket, and also what you're looking for. IFB space is actually the more active than anything else.
So it's the same people or same people really who invest in the primary market that invest also.
So what you'll find
market.
is that they'll go into the primary and then float immediately after an auction. You'll find activity on similar papers with similar tenors right after a primary auction. You'll find a lot of activity on papers with similar tenors. Yes. In the secondary market, a lot of activity, and then it dies down after some time. And most of the time in the secondary market, the IFBs are not as active only because everyone's holding. Everyone's holding to that.
And actually for the IFBs, because they tend to be much long term, because I think the one that CBK floated recently was, I think, around 25-year. Bond. And for that now the players of pension funds will come in because the reports that have been coming out this week is that as at June of last year, pension funds actually beat banks in lending to government. So currently pensions are have lent out more to the government than the banks have now based on that. Now I'm looking at the IFBs and what you've just mentioned. We had a Twitter space with Mango Capital on IFBs. It was an interesting conversation, and I remember Sunil mentioning about the secondary market and how the size of the ticket, is a big determinant of the secondary market. So if the minimum for IFBs investment is normally 100 Gs, but then in the secondary market, for you to sell 100 Gs it's almost impossible. But then if you have a ticket of 1 million bob, 2 million bob, 10 million bob. Now that's much easy to offload.
And again, it works on the investors. Who are these investors? Most of them are banks.
Absolutely.
So who's going to take up 100,000? Even for them, it doesn't make any sense. So they look at the ticket size, as you said, and they're like, okay, does this make sense for my books to dispose of this? Yeah, so it makes sense.
Yeah.
We've had a conversation.
Yeah.
Sorry,
It's okay.
We've had a conversation about aggregating these figures such that the minimum amount does not have to be 100,000, for example. That is just to attract the retail investors, individual retail investors. So to give leeway for like the three of us to come up with the 100K and get one ticket. Yeah. So there's a company that was doing that.
Yeah.
The Sandbox.
Yeah, the Sandbox is called, the company is called, it's by Sycamore Investment.
Yeah,
the app is called Cashlet.
Yeah.
Yeah, and I think also Ndovo, which was recently launched, I think they're doing something around that space.
Are they live?
Yeah, sure. Cashlet is, you can do it.
Have they published anything? Stats on how it's the uptake on that of interest?
I haven't seen any stats as of yet. I haven't seen any stats, but generally, the idea that Issa is talking about. So when it comes to either it's corporate paper or it's government paper, they are able to aggregate. So your 1K, your 2K, to meet the minimum, then send it as one, and probably do the same for other guys. Yeah.
And they've gone to the market with
Absolutely.
Okay.
They're in the sandbox of CMA already.
So I can invest.
Absolutely. Check out the Cashlet app.
Okay.
Yeah.
All right.
Cashlet.
Yeah.
There's also something interesting that I've seen just before this IFB, last one. There seems to be a run for SACCOs or small groups to put their money in the IFB. I don't know how that, something happened, because I say I'd seen a lot of like my Facebook friends, Twitter, they're saying that, they're waiting at CBK, for CBK to open so that they can put in their money. So I was like,
and there are probably people who are not in the finance space.
Who's marketing this?
So who's marketing this? Like, how do these people know this? And you're talking about financial literacy. So I was wondering, was it a government initiative?
I think,
or what happened?
I think they've been listening to this podcast.
Nice one.
Wow. So I mean, that's interesting. It's interesting to know that, and I'm looking at now how that space is structured, and people have come to realize that they are really, apart from buying ploti makuta, there are other investments, because Kenyans have been obsessed with 50 by 100 plots for a long time. So now they've realized that there are actually other pockets of opportunities that you could invest in, and IFBs is tantalizing because, I mean, tax free.
No, what's the risk there?
Yeah.
It's like 98%
And
risk
I was
free.
mentioning
guaranteed.
that also because of the aggregate story that you're having, because it's small groups.
Yeah.
Now you come up as friends
Yes.
and you all contribute a
Yes.
particular amount of money and say that we're going to invest in this
Bond.
and all do different things as opposed to investing in land,
Yeah.
which you'll be at it for a long time. So it's very interesting how things are changing.
Yeah.
The conversation has now shifted, and now I don't know who's changing the conversation. Yes, market map. Yes, you're changing. You're at the forefront of this, but it's of interest now to see, like, even when you're looking at WhatsApp, people are sharing investment ideas aside from land, and I've seen a lot of circulation of bond, invest in government securities. So I'm wondering, is there an individual curating this story somewhere in government? They're sitting there saying, let's send out this WhatsApp and copy it and send to all your groups, forward to as many people as possible, and get that reach, because now there's this flurry of activity amongst small investors coming up to invest in government securities, and it's quite interesting and fascinating, and it's been shared on social media, including WhatsApp groups. It's of interest. It's very interesting.
I'm happy to hear that, and I'm really hoping, I'm really hoping that, because one of our biggest headaches has been the component, the percentage component of retail investors in the capital markets, and particularly at the BOWS. So I'd love to hear the same on the BOWS, that the 10% of retail investors in Kenya goes up to probably even 30.
Yeah. I think, well, if you from the age of 20 to 30, that's when people start getting woke about investment. And they tend to ask, what can I have this money? Where can I invest it? and the answers that come up straight most often is stocks and bonds. At least nowadays, bonds really come up. So I think it originates from there, because I haven't seen anyone marketing the thing about people taking up bonds and all that as an investment. I haven't seen anyone do that.
Okay.
Which is why I really buy the idea that it could be us.
Yeah, definitely. So guys, let's move to another.
Before we move to that, who was doing the Emakiba program?
The Makiba was CBK.
CBK.
CBK. Then why haven't they done it again to the point that Saikamo is coming and doing it like it's something new?
I think it was a lot of work. I think it's a lot of work. And here's my reasoning. It's a lot of work because now these tickets of 3K, why do these tickets of 3K? While you can do a ticket of a minimum of 100 Gs and you can get tickets of 10M. So
People
it's a lot of work. You're dealing with, like, if it's 3K, you're probably dealing with 100,000 investors.
Yeah.
But then if it's tickets of 100 Gs going up, you can probably deal with what, like 1,000 investors?
Oh, another thing, the Emakiba, the three, your returns, they are being sent to your M-Pesa. So I think that's also a lot of work.
And the transactions charge.
Those are very
expensive.
transactions.
But I'm asking for them to shift their goal or focus or objective from just raising the funds for whichever purposes it is they're raising the funds to increasing financial literacy in the country.
I don't,
because again, if it's institutional investors, we have the chunk of these institutional investors are not even Kenyan investors. So again, there's capital flight. So with the interest of just having this money stay back in the country and grow our economy, you could pursue that.
I don't think
it's too much work
about that. It's not their job.
It's not
Plus, look at where the government is. The government is actually on the red zone when it comes to debt. Okay, as at June of last year, they're at what, 71% debt to GDP ratio. So these guys are desperate. They need money. They need a lot of money. We are desperate. Just whoever's
this is not the time to
most,
teach people.
it's not, at least in their perspective.
Wait, I don't know. I don't think it's appropriate for you to say that the government needs this money when there's so much liquidity and limited investment options for investors, local investors here. And as we said, banks are the largest investors of these government securities. So regardless of you talking about capital flight, which I understand still, when you're looking at the banking space, pensions, those are the largest investors overall. Banks are number one.
Kenyan bank.
And then pensions, yes.
Okay.
So regardless of you being an international bank, the money is still here. Do you understand?
That makes sense.
But I'll repatriate my profits to my country or to my parent organization.
Yeah, but the money that you've invested already in that bond is going to be utilized. The government is not looking at what you're doing with the profits. Yeah. So they're not looking at what you're doing with the returns that you're making. They're looking at, are you willing to invest in the government securities? Yes. Do you have excess liquidity? Yes. During this time, for the past 2 years, it's been COVID. There's been little spending and little investments from you and I. So what is this money going to do in the bank coffers? Nothing. So where is the money going to be moved to? Government securities. So yes, you talk about, debt to GDP is quite high, but still there's so much liquidity in the market. Individuals, not individuals, but these banks and institutional investors, pensions are looking at where they're going to place this money.
Now, again, I totally understand what you just said. And maybe let's shift that dial from increasing financial or improving financial literacy to now capital preservation. So the conversation becomes as a method of taking advantage of this excess liquidity that's in the market. Can we prioritize? Because can we prioritize whose money we are taking? Because it's oversubscribed anyway. So let's make sure that we don't leave any Kenyan's money on the table.
Or like what happened with the MTN IPO, where they first gave priority to Ugandans, then to East Africans, and now open it up.
Yes. Okay, that was undersubscribed.
Probably the reason why,
Not really.
Yeah, it was undersubscribed. I can't remember the numbers well.
I believe that's what they do in terms of when you look at the CBK reports and you look at the structure of investors. I believe that's what they do. And that's why I'll just say it's like a trivial thing. Why do you think banks are number one?
So if banks are number one, then there's no capital flight issue then?
I usually think banks are number one because of the interest spread they have. They're crazy. It's they get 14% and they give what? Less than 5 for the same money.
It's business, my brother. So guys, well, that has been a lengthy conversation.
Yeah.